Okay, let's dive right into this explainer. Today, we're decoding the notoriously complex ICAP CFAP 5 Summer 2026 Tax Practices and Planning exam. Our goal here is simple. Really, we're going to transform those dense, headache inducing statutory rules into clear, actionable insights that you can actually understand and apply. We're going to cover the whole spectrum today, going from some seriously heavy corporate calculations all the way over to the nuances of professional ethics.
To make sense of it all, we'll follow a 5-step agenda. 1. Corporate income tax mechanics. 2. Branch operations and deductions. 3. Structuring and e-commerce taxation. 4. Sales tax audits and computations. And finally, 5. Ethics in tax practice. All right, let's jump straight into part 1, corporate income tax mechanics. Looking at question 1's adjustments, the real complexity lies in the granular details. For example, if SSL makes purchases from Balabak Enterprises and they completely miss deducting the withholding tax, or WHT, well, the law doesn't just disallow the whole amount right off the bat. Instead, it mandates a very specific 20% disallowance. That adds exactly 4.8 million rupees straight back to taxable income. Similarly, lease rentals paid out to a Madaraba financing entity. Those are adjusted directly against financial charges. And this is a crucial one. Any internal group disposal of machinery to a subsidiary like RFL means the tax gain or loss is completely ignored, just wiped from the slate.
Now, there is a strict firewall you have to remember when dealing with a subsidiary like PAL. Let's say PAL suffered a pretty brutal business loss of 28.70 million rupees. But hey, they also managed a 7 million rupee capital gain. You might be thinking you can just net them out to save on taxes, right? Absolutely not. The statute strictly demands that a business loss cannot cross-pollinate with a capital gain. That business loss is locked in. It has to be carried forward for the next 3 years.
Moving right along to Section 2, branch operations and deductions. Tackling question 4, we have to ask exactly how much of a foreign head office's expense can be deducted by a local branch in Pakistan. You can't just casually deduct whatever the head office decides to charge. Tax authorities are actively trying to prevent foreign head offices from artificially dumping expenses onto Pakistani branches just to lower their local tax bill. So you have to follow a strict formula. First, isolate the turnover ratio. In this case, Pakistan's turnover of 1,000 million divided by the global 50,000 million gives us exactly 2%. Then, you apply that 2% to the total global head office expenses of 5,000 million. That caps your allowable limit at exactly 100 million rupees. Because the branch tried to claim 105 million, that 5 million excess is strictly rejected, no exceptions.
But beyond head office expenses, there are these highly localized traps you really have to watch out for. For instance, tax depreciation on locally purchased equipment. That is completely wiped out if you forget to deduct the withholding tax. It's a remarkably harsh penalty. Also, if you have a shortfall of 5 million between a total bad debt and previous deductions, that does count as an allowable business deduction. Notice the donation to SIUT, though, which is a registered medical charity. That yields a tax credit, not a straight deductible allowance. And sending profits back to the head office, that branch remittance is treated strictly as a dividend, meaning it is absolutely not a deductible expense.
Up next, Section 3, structuring and e-commerce taxation.
Questions 2 and 3 present a massive structuring dilemma for a business owner like Rashid Hussain. If Rashid just tosses all his manufacturing and corporate training services into one single company, it triggers a massive minimum tax. We're talking a 16.38 million rupee liability. Ouch. However, by legally splitting the operations, putting the manufacturing into an SME and the training into a separate small company, the total liability literally plummets to just 5.25 million rupees. That is over 11 million rupees saved purely through smart, strategic structuring.
So why exactly does that second option work so incredibly well? Well, stepping into the SME regime under the final tax regime, or FTR, gives you incredible tax certainty. If an SME's turnover is sitting below 250 million rupees, they can lock into this path for 3 full years. No surprises. And best of all, it acts as an absolute shield against minimum tax, which frees up massive amounts of working capital. When it comes to e-commerce taxation, the exact withholding agents and rates rely entirely on the payment method being used. If a customer pays via a mobile wallet for, say, a digital graphic design service, the mobile wallet company withholds a 1% income tax. But federal sales tax doesn't even apply because it's a digital service. Conversely, if physical goods are sent via cash on delivery, a 2% tax is withheld directly by the courier company. The medium is the message here, folks. In this digital economy, the medium literally dictates the tax. Let's move into Section 4, Sales Tax Audits and Computations. In Question 5, we look closely at the legal justification for audits. And here's the thing. The commissioner cannot just rely on vague verifications as an excuse to start digging through a company's past. The law aggressively demands objective, written reasons based on clearly identified risk factors. Furthermore, demanding 10-year-old records, that blatantly violates the 6-year statutory limit. Remember, tax authorities are bound by the law just as tightly as the taxpayer is. And when you're restructuring a business, your actions have immediate costly consequences. Simply shutting down a division triggers an immediate tax hit on your inventory. You are forced to pay an 18% sales tax on the 5 million rupee market value of that stock, even though you haven't actually sold a single thing. But if you transfer it to a registered person as a going concern, it is safely zero-rated. That means absolutely zero immediate sales tax is charged. Looking at Bearing Foods input tax from Question 6, we see that there must be a very strict segregation. Out of the total input tax, 5.47 million is admissible credit for local supplies, and that must be fenced off completely from the 0.72 million dedicated specifically to zero-rated exports. This segregation is absolutely vital because export input tax is fully refundable in cash to encourage international trade, whereas your local input tax is trapped by strict adjustment caps. So, how do those adjustment caps actually play out? Well, after filtering out the exemptions and applying that famous 90% input restriction rule, which caps how much credit you can realistically use, we add back the further tax on unregistered supplies and the sales tax withheld. Working through this methodical, line-by-line calculation takes a seriously messy reality and boils it down to a precise 0.44 million net sales tax payable. I gotta say, it's pretty satisfying when the math finally clicks into place like that. Finally, we reach Section 5, Ethics in Tax Practice. The ethical dividing line for Davis & Company in Question 7 is incredibly stark. Finishing up an administrative submission for an old tribunal case, especially where the hearings were already concluded before they became the statutory auditor, is completely acceptable as long as you have the right safeguards. But accepting brand new representation to argue on behalf of an audit client for past years, that completely crosses the line and blatantly violates independence rules. Why exactly is new representation unacceptable, you ask? Because it creates an insurmountable advocacy threat. By acting as the client's cheerleader in court, the auditor totally destroys their objective stance. Additionally, it creates a severe self-review threat. You simply cannot aggressively fight for a tax position in litigation and then turn around a month later and pretend to objectively audit the very tax provisions and contingencies that resulted from your own legal arguments. It just doesn't work. And that brings us to the end of our explainer. I want to leave you with one final thought. Mastery of tax isn't just about crunching the numbers or blindingly applying a formula. It's about seamlessly connecting the strict letter of the law, the strategic reality of the business you're advising, and an unwavering commitment to professional ethics. So the question is, are you prepared to navigate those high-stakes realities in your own practice? Keep studying, keep questioning the rules, and I'll catch you in the next explainer.